All right, welcome back. My name is Patrick Dunawilla. I am the editor of the Chart Report. Today is Thursday, September 23rd. Joining me today is Steve Straza of All Star Charts. Steve, it's been an exciting week. We haven't seen this much volatility in the stock market in about 4 months. The pullback, it started on Monday. We gapped lower, but it was fairly mild and short-lived. I think the max drawdown was less than 4% even. So we still haven't seen that 5% pullback this year that everyone's kind of watching for, including myself. The headlines this week were dominated, as I'm sure you might know, by this Chinese real estate firm called Evergrande and their financial problems potentially spilling over in the US markets. But as our pal Dan Russo pointed out, the high yield spread is not showing any signs of stress. It's hovering there near 2014 lows. And if this truly was a systemic risk, if Evergrande was really a contagion like Lehman Brothers or long-term capital management in 98, we likely would have seen that the credit markets react by now, but we're not, signaling no major signs of stress. So Steve, amid all this excitement, what are you kind of watching, and what, if anything, has changed for you?
Well, first of all, just to hit on Dan's point, I couldn't agree more. We call the bond market the smart money for a reason, because I think I think he said it in the tweet, they tend to sniff out significant moves much faster than other asset classes, right? So what he's basically alluding to is that if there was stress in the credit markets, or if there was stress in risk assets in general, you would see credit spreads start to turn higher. They're trading near, decade-long lows. So that chart would not look anything like that if there was anything bad brewing under the surface.
You have this chart of high yield here. Basically showing something kind of similar. You're not seeing that risk off kind of reaction yet, right?
So basically, this is credit spreads. This is us looking at credit spreads through the inverse of yield. Instead of looking at yields, we're looking at it through price, right? So this is high yield bonds over treasury bonds. If high yield is moving up at a faster rate than treasuries are moving up, then that means that the yield on high yield bonds is moving lower at a faster rate, and that's compressing the credit spread. So the same thing as this chart moves higher, it's the same thing as seeing that credit spreads chart move lower. So if we're knocking on the door, and we've been knocking on the door for months now to new highs, breaking through a critical level of former support, this all looks constructive, and this isn't the type of price action you see in markets that are, drawing down significantly. We could talk more about that.
No, I know you've been talking about the Russell for a while now, and really nothing's changed there, right? I mean, we're still range bound. It's a hot mess, as you like to call it. You're basically just waiting for resolution there. Is that right? What other areas are you kind of looking at?
Yeah. So, I mean, this is the theme of the year, really. If you want to put, price action into a nutshell for 2021, it's this chart. There's nothing that really illustrates what's gone on so far for the majority of this year better than this chart. It's been range bound. It cannot resolve in either direction. Bears get a chance, they fail. Bulls get a chance, they fail. And it seems like every month we're talking about the same thing. Oh, Bulls have it. It's in the Bulls' court. Things are breaking below support. And then it flips right back. It reverses. We have seen so many pattern failures that it's really interesting. But that's a hallmark of sideways, messy markets. So when you're seeing this at the index level, then you drill down to the sector level or the industry group level. I know we brought some good charts around, but you're basically seeing, breakouts fail last week or the week before, and then coming into this week. Yeah, well, coming into this week, just like you said, we had some major selling pressure at the end of last week that we saw follow through for into this week. And again, it looked like, all right, the Bears have it. It's in their court now. And a day later, we rip back. We get the FOMC meeting behind us. The dollar can't break out of its range. Yields are breaking above that 1.4 level, and they sure look like they're resolving higher as of the time we're taping this. These are just not things that you see during markets that are under significant stress, right? You don't see trucking stocks leading and semiconductors and copper digging in at support and crude oil grinding higher. So industrials, again, Bears had it. Looked like they had a breakdown here. The pattern executed for a day, and that's a failed breakdown, fast move higher, and we're getting it already. And we could show so many examples of this too. And when you look at the leadership sectors or industry groups, I mean, what's more important than semiconductors, right? So they were flagging just above their former highs from Q1. Looked like we had a nice breakout on our hands. It failed. Looked like it failed. And then it turned out to be a false start. We ripped right back higher. And today we're, right back above our risk level. So that's a false start, not a failed breakout. So what we're seeing is actually becoming more and more bullish, where the failed breakdowns are confirming and turning into fast moves higher. And we're seeing these automatic reactions today and yesterday. And then what looked to be failed breakouts, basically taking place and occurring, have failed and whipsawed higher and are now just looking like false starts, and looks like price is ready to resume in the direction of the underlying trend. So, again, not things you see during bear markets or even corrective periods.
Yeah, so kind of that theme of just messy markets outside of the S&P 500. I know most of the technicians that I talk to, they are just checking their watch every day, waiting for the Russell 2000 to do anything, to break out of that range, up or down. I mean, it's been months now, and pretty much everyone I talk to in the technical circles, that's their chart that they're really watching, is Russell. And so far, nothing, just sideways.
No.
So we're definitely still waiting resolution on that, and we're probably going to have to continue to, right?
Yeah.
So next, I really want to talk about rates. When we were preparing today, you were like, Pat, the 10-year, the 5-year, the rates charts are the ones to watch right now. And you think that they probably will have some influence over equities next move, basically. So what do you kind of see in there?
So the 10 years at a critical level right now.
Yeah,
if it moves above 1.4, yeah, we're expecting much further upside. If it can't get above 1.4, then it's just more of a mess, right? But we have to start thinking about what are the implications of higher yields now, right?
Yeah.
And basically, I brought along some charts. There are some ETFs out there. They're very illiquid, so we use them as information only. These are not tradable vehicles. But yeah, let's talk about yields first. Go back to the 5 year. Sure. So yields are breaking out, right? So what's going on in an environment where the 5 years breaking out of this base, the 10 years coiling right below 1.4 and key former lows, looks ready to rip higher. So if yields make us, sustainable move higher, what kind of stocks do we want to be in? How do we want to be positioned, right? We don't want to be in defensive assets, and that's been clear already. Defensive sectors are making new lows. The yen looked like it was ready earlier this week and just couldn't get it done. The dollar failed. Safe haven trades are not working. So we want to be positioned offensively in cyclical sectors. This is EQRR, which is Equities for Rising Rates. It's a ProShares ETF. And
I think that's a fascinating ETF. You just showed me this, but I think, I'll let you continue there.
It's designed as a vehicle to bet on higher rates, right? So it's composed of stocks that do well in a rising rate environment.
And what are those areas?
So it's over 50% energy and financials, right?
That's pretty much what it is, right? I mean, look at those two charts. They look really identical.
Just to prove how much of the case that is, right? Because like I said, EQRR is not an investable vehicle in our minds. So we have to find a different way to express this thesis. Well,
it's pretty liquid. Is that the problem?
Nobody trades it. It's just a gappy mess. So that's why I got the line chart going.
But there's information there.
Exactly. So we drilled in, we looked, okay, what is this thing holding? It's just holding energy and financials. So we took equal weight energy, equal weight financials, equal weighted them, turned it into a custom index. Chart looks exactly the same. So if you want to bet on a raising rate environment, if the 10 years above 1.4, I would imagine EQRR breaks out. I would imagine this custom index breaks out. And if it is, it means that financials and energy are doing very well. You're also going to see areas like industrials doing very well too, which we just talked about, that failed move and fast move higher. Probably a great entry here.
Those cyclical sectors, as you said, right?
The global growth sectors, the value, the cyclicals. Yeah. And that's going to be industrials, energy, materials, financials. And what's also interesting is the resilience, not just resilience, but the relative strength from energy futures, which I think is also a tailwind, which makes energy really interesting right here. They've been by far the near-term leader among all the sector ETFs. So I think that's an area you want to pay attention to right now.
Yeah, and Steve, check out this chart from Renaissance Macro that I brought. It's
Love that,
basically
Mac.
saying the same thing that you are. The chart shows which areas of the market tend to do well, of the stock market tend to do well in a rising rate environment. And basically, yeah, banks and energy all the way to the right there. So
See, I haven't seen this. I didn't know that you were going to show this. So
I surprised you, right?
yeah, no, this is great. There's nothing I like more. JC says it all the time too, than when our smart friends who we really respect, like Ren Mack and Jeff DeGraff, agree with us. So that's awesome. Glad to know we're on the same page. Feels good.
So, real quick, yields as we speak, they're already kind of breaking out of that top end of the range.
Sure.
I know you kind of want to wait for confirmation before you say, yes, yields are absolutely resolving higher and the trend is up. So basically, you're saying watch over the next few days. If we're above 1.4, the areas of the stock market that are likely to benefit are energy and financials, the two leading sectors in 2021, right?
And materials and industrials. The more economically sensitive groups are going to do the best. So you want to
what is it bad for? Let me ask you that.
Growth.
We can look here, but
any long duration asset, right, suffers in a rising rate environment. And growth stocks, by definition, are long duration assets because they've been priced for their growth 5 to 10 years into the future, right?
Like software stocks, is that?
Yeah, it's almost like you have to think of interest rates as the discount rate and the cash flow model.
I see.
Getting fundamental here, but it's not good for growth stocks. And then at a certain point too, you have to wonder about the defensive sectors. Like right now, if you can get 3 or 4% yield in a utility stock or a real estate stock, seeing rates at 1.5, 1.6 isn't going to make people say, oh, I'd rather be in the 10-year yield as an alternative to my utility stock that I'm getting 4.5% with minimum volatility. And no. So yields have to raise to a level where they're making bonds more attractive for investors as an alternative. And I think
there's almost like a threshold, you're saying.
Yeah, and I think we're still a good ways off from that. The market will let us know through price, and we'll see it happening. But yeah, it's not happening yet. No.
Well, Steve, I think we got to wrap it up. But thank you so much for joining me and sharing your thoughts. And we look forward to talking next week, right?
Always a good time, man. See you next week.
All right. Thank you.
Thanks, Pat.